Welcome to our webinar on stop loss. A stop loss strategy is something which every private investor needs because it helps you to limit your losses while allowing your profitable investments to run. When you get into a motor car, you put on a seatbelt. You do that not because you're expecting to have an accident that day. If you're expecting to have an accident that day, you wouldn't get into the car in the first place. You do it to protect yourself against the unexpected. Somebody jumps a traffic light in front of you. A stop-loss strategy is the private investor's seatbelt in the stock market. It protects you against the unexpected. So how does it work? In its simplest form, a stop-loss strategy simply consists of placing a limit on how much you are prepared to lose on an investment. Suppose that you have found a share on the JSE which you really like, and that it is trading in the market today for 1,000 cents a share. You've done your homework, you've studied the financials, and the share's price chart. You really like this share, and you want to buy it because you think it is going to go up. But you could be wrong. To protect yourself against that possibility, we suggest that you mark off 10% from the current price of 1,000 cents and set a stop-loss level. That level would then be at 900 cents. And you say to yourself, if the share falls to 900 cents, then clearly my decision to buy it at 1,000 cents was wrong, at least in its timing, if not in both timing and selection. I will therefore acknowledge my mistake by selling the share and so protect the bulk of my capital. If, on the other hand, the share goes up and you were right, then we recommend that you maintain your stop-loss level 10% below the highest market price that the share has reached since you bought it. So when the share reaches 1,500 cents, your stop-loss is 10% below that level at $13.50. Now, if the share begins to fall, when it reaches 13.50 cents, you are out of it. So it works like a ratchet that can only go up but cannot come down. Because the one rule about stop loss is that you cannot move stop loss levels down, only up. So the simple stop loss consists of setting a percentage below the highest price which the share has reached since you bought it, and then selling the share immediately if it crosses below that level. So the question then arises, what stop-loss percentage should you use? Why 10%? I only use 10% because it's easy to calculate. But to answer this question, you need to ask yourself a question. How much am I prepared to lose? If you're not prepared to lose anything, then you shouldn't invest in the share market at all. Shares will always have an element of risk, and you have to take that risk to benefit from the huge upside potential of shares. A stop-loss strategy simply limits that risk to a defined percentage. So ask yourself again, how much are you prepared to lose? For example, are you prepared to lose 50% of an investment? Absolutely not. Because then you must make 100% just to get back to where you started from. Well, what about 25%? You have to choose this level for yourself, and everyone is different. It is a personal decision, and it depends on how risk-averse you are. Speaking for myself, I'm unwilling to lose more than 15% on any stock market investment ever. I simply think it's mindless. And that includes my dealing costs, so my stops are never set more than 12% out. The JSE Overall Index is an average of 99% of the shares traded on the JSE, and it goes up. It's been going up since it began. Consider this chart of the last 35 years of that index. You can see here that despite the various crashes and crises, the index just keeps on going up. In fact, over the long term, the JSE has averaged a return of about 13.8% per annum. For the purposes of this discussion, we could represent this upward trend as a sloping straight line. Now imagine that as a complete beginner, you will be choosing your shares totally at random. So you're going to put a price page, a newspaper price page, up on the wall, stick it up there, tie on the blindfold and throw the darts. And where the darts land, that is what you will buy. If you do that, then I'm sure you'll agree that half of your selections will beat that index and the other half will underperform it. That must be true because the index is an average of the shares from which you are selecting. If you are a mathematician or an engineer, then you would say that your selections will form a scatter plot that will exactly regress to the index line. Now, if on those shares which beat the index, you can make 200%, 300% or more, but on those which underperform the index, you cut your losses at 15%, can you see that even if you choose your shares completely at random, so long as you have a strict stop-loss strategy, you must outperform the index? Isn't that an interesting thought? Imagine if you could use a stop-loss strategy on the roulette table in the casino. When you win, you double your money. When you lose, you cut your losses at 15%. The casino will go out of business overnight. And yet here on the JSE, you have a market which on average goes up by 13.8% per annum. So statistically, your probability of choosing a winner is already higher than your probability of choosing a loser. And you can apply a stop-loss strategy. Now let me tell you a story about stop-loss. Several years ago, I was down in Durban delivering a lecture on the share market. And as part of my lecture, I explained about stop-loss. After the lecture, a man approached me, and I could see immediately that he was very unhappy. He told me that he had bought a large parcel of shares in a certain company for 220 cents, and that they had now fallen to 168 cents. He said to me, "So I can see what you say about stop-loss, and it makes perfect sense. But what must I do now?" I said to him, "Your problem is that you are carrying your loss around with you like a great ball and chain. It is paralyzing your mind and dominating your thoughts. You cannot sleep at night because of it. Now the only way to get rid of that problem is to sell those shares, because then you can't go on pretending that you didn't make a mistake." When I said that, he buried his head in his hands and he said, No, I can't sell them now, not now." So I said to him, "Well, there's one other thing you can do. Pretend that you bought the shares today at 168 cents. Establish your stop-loss level from that and go forward from here." Anyway, I was back down in Durban about 6 months later and I met the same man. Only he still had not sold those shares, but by that time they were trading for just 68 cents. You see, some people must pay more school fees than others. You can hear what I have to say about stop-loss now, or you can go out there and discover the truth for yourself the hard way. Finally, I have some words of advice to give you about stop-loss. If the share that you choose goes up and you are making a good profit from it, then you can widen your stop-loss. So, for example, if the share is up 50% from what you paid for it, then it would be reasonable to widen your stop-loss to, say, 15%. And if it is up 100% from what you paid, or more, you could comfortably increase your stop-loss level to as much as 25%. Secondly, we advise you to value your shares at their stop-loss level. Most people value their shares either at the market price or at what they cost. If you value them at what they cost, then you will be completely out of touch because the market price will change every day, and so will your stop-loss. If you value them at the market price, then you will run into difficulties. Because when you have to sell them on stop-loss, you will find yourself trying to sell something that you think is worth more than you will get for it. And that is a psychological difficulty. If you value them at their stop-loss, then you will find that you have no difficulty in selling them when they reach stop-loss because that's what you believe them to be worth. That's the level at which you have made a strategic decision to sell out. That is the price you can sleep with at night. If you get into the habit of doing this, then the act of selling on stop loss will not involve any psychological discomfort, because in your mind that is what the shares are worth anyway. So it is far better and easier psychologically to take your loss when you buy, not when you sell. Thirdly, you should understand that a stop loss is not a selling technique. It is like the safety net under the trapeze artist. It is there to catch and save you if you make a mistake. You should use your normal analysis, both technical and fundamental, to sell out of the share as close to the highest point in the cycle as you can get. But if you make a mistake and you end up at your stop loss level, then it is too late for clever arguments. Your entire focus should then be on selling out immediately to protect the bulk of your capital. Fourthly, for the purposes of stop loss, you should always use the share's closing price. Do not worry about what happens in the market during the day. Just look at the end of the day and see if your shares have closed below their stops. If they have, then put in a market order to sell the shares the next day. Remember, buying shares on the JSE without a stop loss strategy is like getting into a motor car without putting on your seatbelt. It just does not make any sense. Being successful in the share market is not so much about making money as it is about not losing it.